The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to the ConsistentOptionsIncome.com webinar on how to trade options for consistent income. Let's get started. Okay, here's the agenda for today. First, we're going to take a moment to talk about the current market conditions, try to give us some context, how the strategy fits in different kinds of market conditions. Then we'll talk about the let's make a deal mathematical problem. I think it's really important aspect of why we're successful. It's a little bit tedious to go through to prove the mathematical phenomena to you, but I think the takeaway is profound, and it underlies why we trade the way we do, and I think why we're successful. Then we'll talk about the auction process and how it's a better reflection about how the market works. And then we'll talk about smart levels, which are products of the auction process that help us adjust our trade. It helps with the timing of our adjustments. And then we'll talk about the options income strategy and why it's so consistent, and we'll give you some details on that. And then we'll go into the Q&A based on feedback I get from the webinars. This is the part that most people find valuable because it's an opportunity to, ask some questions and clear up some of those gray areas that you might have. So let's go ahead and get started. So this is a current chart of the S&P 500 as of this date of this webinar, and you can see it's kind of ugly, although it's kind of orderly, really. The march down has been fairly orderly, but it's been pretty aggressive to the downside. And for income traders, this type of market creates a lot of fear and uncertainty. But basically, let me see if I can get my drawing tool working here. I'm going to go ahead and draw here. So one of our trades was taken right in this area here, so we kind of caught that up move. But our last trade was down here, and you can see that even in a down market, we ended up benefiting from a directional move to the upside here and a down move here. In fact, large moves like this, we can actually make more than our 5% target. So we actually did pretty well. The point is that you need to have a strategy that works in all different kinds of market conditions. If you were a typical income trader with a smattering of typical income trades, these types of markets would really be hurting your positions. It's really hard to make money in this kind of market. So that's the big takeaway. I just wanted to mention that basically because I'm sure that current market conditions are on everybody's mind, and you're wondering how our strategy would be doing. We made, I think, somewhere in this area here, we made something like 6%. So we did a little bit better than our 5%. And this one was just such a strong down move, we basically couldn't get out of its way fast enough, and we captured about 7% just in a few days. So that's good stuff. All right, let's make a deal. So if you're old enough, you probably remember this game show. I think it was on daytime TV, and Monty Hall had this game show where people, contestants would show up in kind of crazy costumes. You can see on the slide there in the upper right-hand corner. And it was kind of a zany, fun show. And Monty Hall would give away a lot of prizes during the show. And that's why people dressed up, to get noticed so they could get, an opportunity to win some of the prizes. Now, one of the big games that he used to play was he would have 3 doors on the stage, like you see in the bottom of the slide there, the bottom image. And there'd be doors 1, 2, and 3. And so he would give the contestants an opportunity to pick one of the doors, and behind one of the doors was usually like a car, a brand new car. So there's a pretty big motivation to get it right. So what the contestant would do is they'd choose one of the doors, but then before he would open the door that they chose, he would open one of the other two doors that was unchosen, and there would be some sort of gag, prize behind the door that he opens, like a mule or something like that. And then the interesting part was that he would give the contestant the opportunity to switch their original choice. So if the contestant originally chose door number 1, let's say, Monty would open door number 3 and show that there was, a losing prize behind door number 3, and it wasn't the new car. So now we know that the car was behind doors, either door number 1 or door number 2. So since the contestant had chosen door number 1, he gave them a chance to change their choice to door number 2. And most contestants usually thought of it as kind of a trick, that he was trying to get them to switch away from the car. And besides that, it was at that point only 2 doors. There's a 50-50 chance, so they usually would stick with their original choice. However, it turns out mathematically that wasn't the best decision. And so let's take a look at that. So here's a link on this slide here where anybody can go and see games that you can play to simulate this mathematical problem. Now, I've just chosen one. You could do a Google search. You could find probably hundreds of them. But let's take a look at this one here. And you can go there yourself if you want to check this out. Okay. So here's the, it's just a web page with this little simulation game on it. And what we're going to do is we're going to run through 2 different simulations. I'm going to do 10 iterations of each. And the first iteration, what I'm going to do is I'm going to stay with my original choice the way most contestants do. And you can see that'll be reflected here in the counts. And then I'll do the game again, and I'll do it 10 times in a row, each time staying with my original choice. Then what I'm going to do is I'm going to run it 10 times, and I'm going to switch my original choice. And we'll see which simulation comes out better. So let's get started. So I'm going to choose door number 1. I'm going to stay with door number 1. You can see I lost. I'm going to pick door number 2. I'm going to stay with door number 2. I lost again. I'm going to pick door number 3 and stay with door number 3. I lost again. Pick door number 1, stay with door number 1. This time I won. Pick door number 2, stay with door number 2. Pick door number 3, stay with door number 3. Pick door number 1, stay with door number 1. Pick door number 2, stay with door number 2. Pick door number 3, stay with door number 3. Pick door number 1 and stay with door number 1. Now this time you can see I only won once, which is pretty low. That's actually lower than it usually is. I've done this simulation lots of times, and this would usually comes out a little bit higher than this, and we'll talk about that in a minute. So let's start over. This time we're going to switch. So I'm going to pick door number 1. I'm going to switch. I'm going to pick door number 2. Then I'm going to switch. Pick door number 3. Switch. Pick door number 1 and switch. Pick door number 2 and switch. Pick door number 3 and switch. Pick door number 1 and switch. Pick door number 2 and switch. Pick door number 3 and switch. Pick door number 1 and switch. Now you can see in this case, when I switched, I won 6 times instead of only winning 1 time when I stayed. Now the statistics actually should come out somewhere right around 33 1/3% of the time you win if you stay with the original choice, and they should come out around 66%, pretty close to our simulation here. I've done this game probably hundreds of times now, and every time by switching your choice, you do better, regardless of what the stats are. Now, if I did this 1,000 times each of these games, it's probably going to come out much closer to 33% wins for staying and 66% wins for switching. So let's go back to the PowerPoint and we'll kind of talk about this phenomena. All right, so I'm just going to read this slide here. So the answer to why this works this way is because it goes against our intuition that with two unopened doors left, the odds are 50-50 that the car is behind one of them. But when you stick with door number one, you win only if the original choice was correct, which happens only 1 in 3 times on average. If you switch, you'll win whenever your original choice was wrong, which happens 2 out of 3 times. So you can see that intuitively, by staying with our original choice, we were making the wrong choice statistically and mathematically. So the key here, one of the takeaways is that our brains aren't wired to understand probabilities correctly. In the markets, we can be easily deceived. And that by modifying our initial prediction seems to provide some advantage because our original choice is usually wrong. And so the takeaway here is we want to incorporate that into our trading. We want to understand that probably our original choice, whatever trade we're making, whatever time we're doing it, is probably wrong. And so we want to be in a position where we can adjust, be able to switch our choice, if you will, if it turns out that it looks like we're going to be wrong. And so that's where our whole adjustment approach comes from this principle that we're usually wrong in our initial choice. Because think of all the different possibilities that you have in the markets to make decisions. So we're much more likely to be wrong most of the time. And so what we want to do is have a situation where we can adjust our way to being on the right side of the market. And that makes all the difference in our trading. All right, let's talk about auction theory a little bit, because this is another tenet of the way we trade our strategy. So in a typical auction, like at Sotheby's, there'll be an auctioneer. In this case, the auctioneer is auctioning off a vase, but it could be a painting. You've seen it probably, many times in movies and TV. And so in this case, the auctioneer is selling something. And then on the other side, in the room, in the chairs, there's a bunch of people who are buying. And so when the auctioneer starts the auction, someone bids for that vase. And usually, whenever you've seen this, it starts off kind of slow, right? It takes a while to get that first bid, and then all of a sudden it takes a little bit, less time for someone else to bid against the original bid, and then, there's someone else, and then it kind of speeds up, right? There's this sort of frenzy kind of in the middle of the auction. People are thinking they can get, the thing that's being auctioned at their price, and then the frenzy kind of dies off a little bit and kind of slows down, right? And then there's maybe just one hand, and they keep auctioning, and there's no bids, and then all of a sudden there's that final bidder, right? Now, one of the takeaways from going through this little short simulation here is that almost everybody in that room thinks that last guy paying $145 is paying too much, right? Nobody else is willing to bid that much. So at the top of this auction, most of the market, most of the participants think the price that's being paid is too much. So we can use that to our advantage. When we see an auction, at the end of an auction, we've probably gone a little bit too far, right? And so it's natural for the market to sort of recover from that because the rest of the market isn't willing to buy at those prices, at least not at the moment, unless something else changes. So one of the other key takeaways is that the auction ends when the buyers are exhausted, right? Basically, a lot of times when a market makes a big move up, people will say, well, the market turned around when the sellers came in, right? But that's really not what's happening. It seems like a subtle difference, but it can make a big difference in the way you approach the markets. Same way with the selling auction. If the market's selling off to the downside, that selling movement, the downward movement, is going to stop when we run out of sellers, not necessarily when buyers come in. Now, if the market does turn around from a downturn and starts going up, at some point buyers will come in, but the turnaround doesn't happen because of the buyers. It happens because we run out of sellers. And so one other way to look at this is that we want to be selling on strength because we know that at the top of an auction or a buying process, that its market's probably going to be overpriced, right? And it's going to return closer to where most of the market participants think the price should be. And so we're going to sell on strength and buy on weakness. These are kind of general principles that we want to employ. Now, when I talk about auction process, many people automatically think of the market profile charting technique. It's been pretty well marketed, and I think that the market profile charting technique is good in that it originated from the auction process, but it was really developed in the early 1990s, and I think the software just wasn't very good at the time. And so there was this sort of ham-fisted charting technique that they came up with based on the auction process, mostly because the software wasn't there to support anything more sophisticated. So on my website, I go into some detail about the flaws in the market profile charting technique. And right for now, though, I just want to emphasize that we're not using the market profile charting technique. We're just looking for auctions, and what we're doing is we're finding levels above and below those auctions where we want to be engaged. The other principle that I think is important to point out here is this random versus predictable debate. Like a lot of market participants, a lot of traders will think that the market is random and therefore efficient, right? That all the market behavior can fit nicely within a nice bell curve. The fact is, in the markets, statistically aberrant things happen all the time. And that's a truism that takes you a while to understand. But even though it seems like it's mathematical and the market is operating with numbers, it doesn't really fit in to nice bell curves all the time. Statistically aberrant things happen a lot. And so we have to bake that into our trading. On the other side of the spectrum, there's a group of people who think that the market is predictable, that it's inefficient. If it's inefficient, it should be predictable. But anybody who's spent a lot of time using technical analysis to trade knows that that's not true either. So there's this kind of weird situation where the two theories about the way the market works are both wrong. And I think the reason they're wrong is because they think of the markets as some sort of mathematical problem that needs to be solved. It took me a long time to figure out that's just not the case. The market is much more like a person, right? Could we come up with a mathematical formula to try and predict what your movements are going to be today, right, as a human being? It's going to be very hard to do that on a consistent basis day to day. So we need to start treating the markets more like an organic being, and watching for these auctions is part of that organic nature of the markets. And so if we can get tuned into this auction process, all of a sudden we're going to have a much better feel for what the market's doing and where it's heading. These levels that we find from the auctions become ideal places not only to be engaged for our trading, but they're ideal prices for adjusting our options trade. So that's the primary objective here, is to look at the auction, find these significant price levels in the market where we want to become engaged, and those are the prices where we're going to adjust our trade. So that's the whole purpose behind looking at the auction. So what are smart levels? Smart levels are basically those levels that we find above and below the auctions that we find. So they're significant price levels for any market with decent trading volume. So if you have an actively traded market, you're going to be able to use the technique that I teach in the course to find these levels, and you're going to be able to trade any market you want. In fact, once you start doing this day in and day out, you're not going to want to trade a market without knowing where the smart levels are. I have many people tell me over and over, after they learn the smart levels technique, they never look at a chart the same way again, right? You see something that was always there. That's the profound thing that you're going to pick up on, is like, I can't believe I never saw this before. And then once you see it, you're never going to look at a chart the same way again. Now we create the smart levels each evening after the market closes, and before the market opened the next trading day. So we got plenty of time. It's not like we're trying to divine tea leaves during the day, right? We have this process that we go through at the end of the day. And once you get good at finding these auctions, it's only going to take you like, say, 5 minutes. You're going to look at the day's trading for a particular market, find the auctions, put your levels around those auctions, and you're done. So it's really not difficult or time consuming. Now, these smart levels can improve your trading no matter what you're doing. We use them as these significant levels at which we want to adjust our trade. But even if you're using a MACD to trade the markets or whatever, you should know where these smart levels are, because it could impact your trade. If you have a trading signal from your own approach and it's right below a smart level, well, you're going to want to wait and see how that smart level gets negotiated before you maybe take your position. And the smart levels are created using a unique implementation of auction market theory. And like I said, these are ideal locations to adjust our options trade. And the smart levels approach and the education on how to find the smart levels is included with the purchase of the options course. Okay, the options income strategy. One of the things I want to emphasize is that I think this is a different kind of strategy than what most people are doing. Those two icons up there, no credit spreads, no iron condors, came out of my experience going to the Traders Expo in Las Vegas in November of 2008. And if you remember, in 2008, that was the financial crisis, and basically things were going crazy. The first day of the Traders Expo was the day we were supposed to put our trade on. And that day, you didn't have to be even participating much to know that the market was coming unhinged. The wheels were coming off the bus, and there was a lot of fear. And what most people were doing was basically just heading for the sidelines. We put the trade on anyways, and it's never really happened before or since, but basically the next morning everybody realized the market wasn't going to zero, and all the implied volatility came out of the market, and we made our money on our trade in a single day, just from the close to the open. So it was kind of I was a little intimidated, to be honest, about putting the trade on because of the market conditions, especially that day. And but I had a lot of faith in the trade, and besides, I was at the Traders Expo. I was going to be talking to a lot of the people who were trading the approach, and I couldn't say that I didn't put the trade on, right? So it was really very reassuring that the trading approach could handle that kind of market situation just as easily as it handles a lot of the other market situations. That's not going to happen all the time, obviously. But one of the things that people told me as they came by my booth at the Traders Expo was something along the lines of, I've been trading credit spreads or iron condors for 2 years. I've been doing really well, but I just gave back all my money, right? And so I just wanted to make sure I put those two icons on my website to kind of emphasize the fact that what we're doing here is a little bit different than your typical income trader. We're not just trading simple credit spreads and iron condors. So this slide is meant to sort of flesh out kind of what we're doing, get as close as I can to letting you know what the trade is and how it works. So I teach this trade using the RUT cash index options only. Now, in the course, I go into some reasons why we trade the RUT cash index options, but there's nothing curve fitted about this the approach. We haven't curve fitted a bunch of data or a million iterations to come up with a trading technique. It's a very sort of pragmatic approach. There's nothing computer generated or computer tested about it. It's just a very straightforward, simple approach. And I prefer to use the RUT cash index options, but I have a lot of traders tell me that they're doing just as well trading SPX and markets like that. So again, there's nothing curve fitted about it. Now, in the trading approach, we sell multiple puts and calls, right? So we're net short premium, but we also buy puts and calls to control our margin and protect the credit, right? So it's a multi-leg complex position that we have to start with, and we'll go into why we do that in just a minute. Now, the other nice thing about the trade is that we're only trading the front month only, right? Usually about 30 days out. That simples things up, and it gets rid of the potential for us to have calendar implied volatility risk. If you got options spread across multiple calendar months, all of a sudden you really have to be a predictor of implied volatility in addition to the direction of the market, and we don't want to be in that business because it's very hard to do. Now, it's always a limited margin, limited risk trade, so you can trade this in your IRA. So that's nice. For most of the traders I talk to are trading their IRA, so it's a fixed margin, fixed risk trade. So we can. The only thing I think you can't do in your IRA is sell stock short or be naked short calls. And again, there's no need to find trades, right? We're putting this trade on at a certain time in the expiration cycle. A lot of trading techniques require you to go out there and hunt through all this data to try and find that, beautiful, idyllic condition, and then put your trade on, right? Of course, those things never work out even after all that work. But in this case, we're not having to go find special situations. We just put this trade on, kind of like I was telling you about, like I did at the Traders Expo. Just as at a certain point in the expiration cycle, we put the trade on, and then we just manage the trade until we have a profit, right? We want to make our money from the way we manage the trade, not from being, perfect in terms of our execution timing or the particular trade that we're trading. Now, the initial trade is taken for a credit, which means we have time decay really working on our side. But we also have a mechanical adjustment approach. We have a method of deciding when to adjust our trade. So on the one hand, we have time decay working for us, but we also can make money from significant directional moves. So we've got both things working for us. So you can either think of it as a time decay trade that's sort of protected by directional adjustments, or you can think of it as a directional trade whose inefficiencies are made up by being able to have time decay on our side. Time decay is a beautiful thing. All we got to do is wake up and we get that time decay. So we definitely want that on our side. Now, why is this trade so consistent? A lot of people wonder, why is it so consistent? Now, one of the things people look at is the returns on the trade, and you think, well, that's really consistent. But those returns are made up of multiple adjustments, right? I think if we just were sort of taking bets in the market and we had the same track record that we do, it would be very suspect, right? But each trade that we do, each time we put this trade on, we do a lot of things that are proven wrong. So we make a lot of moves that end up being wrong. We'd rather have not done them. But we do it in a way, in a process that by the time we get to the end of the process, it's not that hard to get our 5% profit, right? So these three bullets here are kind of why I think it's consistent. But it's also important to remember that any given month, it's made up of multiple, the initial trade and then all the adjustments put together to give us our 5%. And we're not always right on our adjustments. We just do the adjustments in a way that we can continue to do the adjustments until we have our profit. So the keys, I think, for consistency are that the initial trade is chosen for its adjustability. I think that's the problem that a lot of traders make. They go into a trade, hoping that the market stays within their, short strikes, let's say for an iron condor. But they don't realize that the trade they put on isn't adjustable. They probably don't even think about adjusting it really, right? They just want it to stay between those two strikes. But if you watch some of the free videos on my website, I go into the fact that, if you got a 70% probability of profit on an iron condor, you also have a 70% chance that one of your short strikes is going to be violated. So at that point, you're going to be looking at possibly adjusting that iron condor, and it's just not a very adjustable trade. So we want to choose a trade structure that is adjustable. So we start off on a much better foot, and we're able to adjust, whereas a lot of trades that people do aren't that adjustable to begin with. And then we go into trade planning to adjust it, right? That's a big difference in mindset, where like if you go into an iron condor and you're just hoping and praying that the market doesn't violate your short strikes, you have this built-in resistance to doing the right thing. As the market's giving you new information, you can't react to that because you have a trade that's not adjustable. So we have the psychological benefit of going into trade planning to adjust it. We know we're going to have to adjust it. And so when something's happening, it could be adverse or beneficial, we have something that we can do. And that's very psychologically pleasing. So we go into the trade with this plan to adjust, and that makes it a lot easier to deal with the market as it develops. Also, we have a profit target that's a small portion of the available profit. So if you look at an iron condor, right, you have a very small potential profit compared to your risk in the trade, right? And what a lot of people do, in order to get all that, that profit out of an iron condor, you got to stick around for a really long time. A lot of people use a rule of thumb: I want to get 80% of my profit out of the iron condor, and then I'll close it, right? Well, to get 80% out of it, you're going to have to wait pretty darn close to expiration to get 80% out of an iron condor, right? So you're trying to get a large part of a very small potential profit, right? So we're turning that around, and what we're saying is we're going to take a very small profit, only 5%, of a much larger potential profit. So it's much easier to do. So as you're making this trade, you're doing adjustments and whatnot, you'll often just be surprised that all of a sudden you'll have your 5% profit, right? As long as the market moves through the profit zone that you've created for the market, we're trying to provide this nice target for the market, and we're kind of moving it around as the market develops. And all we got to do is have the market move through that profit zone at some point during the trade, and we're going to be able to capture our 5%. So this small portion of a potential profit is much easier to achieve, and that really helps with our consistency as well. Okay, large event risk. This is what most traders end up asking me questions about, right? They're worried about large market events, because if you've been an income trader for a while and you're trading options, large directional moves are very harmful, and you have to do something to protect yourself from those. And so that's what people worry about the most if they're income traders. Now, people used to ask me, when I first published the course, what about 1987? What about 9/11? And of course, I wasn't trading this approach back then. But so I went back and looked at those charts, right? And it turns out that we wouldn't have been in the market when those events happened. So part of our risk reduction is that we're not in the market all the time. So we're not going to have to live through everything that the market throws at traders day in and day out, right? We put this trade on at a certain point in the expiration cycle, the monthly expiration cycle, and then we close the trade as soon as we can with our 5% profit. And so there's a portion of the month where we're not trading, and we're not exposed to any risk during that period. So it's kind of an unsexy risk reduction, not having been in the market. Now, most of these situations that people ask me about, I go back and look, and we weren't in the market. We just happened to not be in the market. Now, that doesn't mean that our trade couldn't have possibly overlapped with those situations. It just means most of the time it's not, right? Now, what if the market had overlapped one of our trades, right? But what if 1987 had happened when we were in the trade? And if you go back and look at the charts, you can see that going into those events, the market is usually slowly, orderly heading into a downturn. And as long as the market is slowly orderly in its process of moving down, we're able to adjust our trade. Worst case scenario would be when we have a long bias in our trade and all of a sudden the market makes a big down move, right? But if you look at a lot of these market crashes or big moves, you'll see that the market was already going down in a very orderly way before the big event happened. And even 9/11, for some strange reason, or it could be some probably fuels some conspiracy theories, the market was already heading down into 9/11. So we would have already had a short bias. As long as the market provides an opportunity for us to adjust our trade to a short bias because the market's heading down, we can profit quite a bit actually from those big moves because we'll already have a short bias in our trade, and as the market heads way down, we don't care where it goes, right? The more the better once we have a short bias. The problem would only come is if we didn't have an opportunity to establish a short bias. And we always have a bias in our trade. It doesn't mean we're trying to predict the market. We just kind of go with the market flow, and if we need to change our bias, we're willing to do that. So as long as the market gives us an opportunity to set the bias in the right way, which most of these big downturns, you can go back and look at the charts, most of these big downturns do allow that. Now, our risk in the trade is a little bit more mundane. The real risk in our trade is, at least the thing that I worry about the most, is that we end up adjusting our trade and then the market does exactly the opposite. And then we adjust our trade again and the market does exactly the opposite. And we adjust it again, the market does exactly the opposite, right? So that happens a lot to our trade, but we are adjusting in a way that we can withstand quite a bit of that. But at some point, obviously, that's going to hurt us. So that's really what you end up worrying about. Now, fortunately for us, the way the market tends to operate is it goes around and it kind of just hurts all the trend traders, and then it comes back and hurts all the oscillator traders, right? It never really does one thing for very long. So sometimes we get caught in a situation where the market's just giving us, a lot of problems, but then all of a sudden it moves on and does something else, and that's when we're able to come back and make our profit. So really that's kind of what we worry about more so than the large event risk. Okay, let's quickly review what we've learned about how we should be trading. We've learned that changing and adjusting our original prediction can put the odds in our favor. Right from the Monty Hall example, we know that probably our original position, our original guess, our original prediction is going to be wrong, right? And so if we have a strategy where we can change our original prediction and try to get in sync with the market, we're going to do a lot better than just sort of putting our flags in the sand at certain points and sticking by it, no matter what happens. Those are basically casino bets, right? What we want is something that's more strategic and can put us in a position where we can evolve away from our original prediction so that we can possibly be a winner in the end. Now, also we learned that using inflection points created by auctions can help us avoid random movements in the market, right? In between the smart levels, in between the auctions ranges, the market pretty much behaves in a random pattern, and we want to stay out of that, right? That's why if people find it so hard to make money in the markets, is that most of the areas in which they're involved in their trading are pretty much random movements, and it's very hard to be correct and make money that way. So what we want to do is we want to wait to adjust our trade or make new trades or trade in a different direction until the market comes to an inflection point where it has to make a decision, right? The smart levels are points in the market where the market has to make a decision. In between the smart levels, it's random. Who knows what's going to happen, right? But we found that with the smart levels, those become inflection points where the market has to make a decision. We don't necessarily know what decision it's going to make, but those are the ideal locations for us to become engaged. And also we've learned that using a flexible option structure can provide a vehicle that allows us to adjust our position as the market moves. So it's one thing to say that, in the Monty Hall example that, we know our original prediction is going to be wrong, but what do you do about it, right? Well, we come up with an option structure that's flexible enough so that we can adjust it and modify our original prediction as the market moves. So putting all of these things together, we come up with a trading strategy that's head and shoulders above anything else anybody else is doing out there. Okay, a little bit about the course. The course comes via online videos. Initially, we kind of go into some options theory, why do we trade the way we do? And then there's some, I go over the rules. Now you can get through the options theory videos and the rules videos pretty quickly, and that's usually where most options courses stop, or for that matter, most trading courses stop. They basically tell you some theory. It sounds good. I've never heard a theory about trading that I didn't think sounded good. Right? They all sound good. Then they'll teach you some rules. But what happens? You get home and you start trading those things, and then all of a sudden you figure out where all the warts are, right? So I basically created this course the way I'd want to have a course if I was taking a course. So I go into the options theory and rules. That's important. You gotta spell that out. But I also include 48 monthly trading videos and recaps in the course. So each one of those monthly recaps, each one of those monthly videos, we go back in time and we trade day by day using real data from the past, and we see how those trades develop. And what you'll see is that, almost no trading months are the same, right? There's all these different kinds of situations. So if all you had known is the options theory and rules and you were trading on your own moving forward, there's all these situations that your mind wouldn't have connected, right? There's all these sort of gray areas where you sort of connect the dots based on your own experience and whatnot, but you really don't know what was between those dots, right? So what this does is it kind of fleshes that out, and it takes you through all these 48 different monthly situations, and it just reinforces for you that, yeah, we sometimes get challenged by the market, but if we just stick to the rules and we keep adjusting the trade the way we're supposed to, we end up coming out with a profit. In fact, the 2008, the financial crisis, we made money in all of those months through the end of 2008. And those videos are in the monthly recaps. And you can go back and watch those videos. Sometimes they were easy, like the one I described at the Traders Expo in November of 2008, but we were challenged in some of the other trading months. So it doesn't mean that there's a free lunch and we don't get some heat from the way the market moves. But I think what you do is if you watch all 48 monthly trading videos, you can see and build some confidence. Hey, if I just keep applying these rules and doing my adjustments, I'm going to end up making a profit in all these months. And so what happens is, because of the theory, obviously, hopefully the theory is right, hopefully the rules are right. Once you get through all those 48 monthly trading videos, you're going to have some confidence when you put your first trade on. Right, you'll have some real experience. You'll have seen it in action, and then when things come up, you're not going to be blindsided and have a hard time figuring out what to do. You'll have some confidence in applying the rules. Okay, so now what? So you'll receive a link to a recording of the webinar. So if you came in late or you can't stay for the Q&A session, you'll be able to rewatch the webinar. Also, don't forget that if you go to consistentoptionsincome.com, there's a bunch of free videos on there that should also help you understand a little bit more about the way we're trading. All right, so here's my contact info. Feel free to give me a call or send me an email. Usually after a webinar, I'm pretty swamped, so it may take me a little bit longer to get back to you, but I end up returning all my calls and emails. So feel free to, if we don't cover your questions in the Q&A or you have to leave early, go ahead and contact me directly. So let's go ahead and start handling some of the questions. All right, so Tony's asking, so how did you discover the strategy? Okay, so obviously this strategy just wasn't sitting under a rock somewhere where I really discovered it. It took a lot of just really difficult, time-consuming effort. It was a problem that I had to solve, and throughout all the 90s, I was pretty much writing programmed algorithmic trading approaches. I was treating the market like a mathematical formula that had to be solved, and I don't think that in the end that was possible. And so that was a big hurdle for me, was to come to grips with the fact that the market wasn't predictable. And so I started looking for other ways to attack the market, and that's when I got into options. And the first options course I took was George Fontenelle's Optionetics. It was a much different course back then. He basically had only one strategy, as far as I could tell, and that was a synthetic straddle. So you'd buy a bunch of stock, and you'd sell, or you'd buy 2 puts with the stock, and then you'd adjust it back to delta neutral with stock as the market moved. Now, when you adjusted with stock, made a big difference. It was the difference between winning and losing, and it really was difficult to do and didn't really work out. But it whetted my appetite for being able to make money from the way I managed the trade or adjusted the trade, as opposed to just making a prediction. And so that set me on the quest to try to find out a way to take an initial position and then adjust it as the market moves, so that I can end up capturing a profit at some point. Now, the way you adjust the trade makes a big difference, right? You can really run your margin up. There's a bunch of different sort of ideas that were out there that I worked through, where, depending on what happened, you'd really ratchet up your margin really quick. So we needed to control margin. So that was a really important aspect. So it just took a lot of hard work and trying a bunch of different things. So it really wasn't a discovery as much as just the result of trying a bunch of different things. Okay. Alicia's asking, can you take a bigger than 5% profit? Yeah, actually, in the course I teach 3 different adjustment approaches. Most traders end up using the original, which is what we traded right through the end of 2008, or the advanced or smart levels approach, which is what I use exclusively now because that gives us such an edge. But with the smart levels, I trade with a 5% target. But a lot of times the market will move. For example, this last 2 trades, it would have been pretty hard to take 5% or less, because the market was moving so fast in one direction. So I think November was like 6%, and December was 7%, right? Just in a few days. So you can take larger than 5%, and sometimes we do. I like having a profit target. With the original adjustment approach, we just didn't have, it's easier to manage trades because we don't check it as often. So it's kind of axiomatic with this trade. The longer you let it go, the bigger the profit. But I think it's important that I point out that a lot of the rules in this strategy are things that were in my comfort zone, right? I thought 5% per month, which adds up to 60% per year, right, was very reasonable and achievable, right? So that became my target. I don't have a million or a trillion, computer iterations to justify the 5%. So I do have traders who tell me they're taking more, and I have traders who tell me they're taking less because they want it, more of a sure thing. So, putting all the rules together works, but people end up doing things that aren't in the rules that tell me about them. I'm like, why are you doing that? And they're just, they have some reason for it, and they're still making money. So one of the things you'll realize in the 48 monthly trading videos is that it's a very robust strategy. You'll see sometimes where like a profit target will come along for some reason based on rules, we kind of miss it, but then another profit opportunity will come along later. So it's a very robust strategy. You can make mistakes. I have traders call me or email me all the time, and they say that they made a mistake. By the time they email me, they usually know they made a mistake, but they still end up making money, right? It happens a lot. So it's a very robust approach. You don't have to get things exactly right. It's a very pragmatic approach, and I think because it's not computer generated with millions of iterations, making it really curve fitted, I think that's what helps keep it very robust. Bob's asking, okay, if you put the trade on, can you put it on again after 2 days? So if we got out of the trade quickly, can we just put the trade right back on instead of waiting to the next month? Okay, got it. So there's two things there. I mean, this last trade in December, we were out in like 3 days. So yeah, the temptation is just to go ahead and put it back on. And for me, I like being out of the market. I think it's a risk reducer. It's not very sexy, but it is definitely a risk reducer. Now, I'm not really tempted if I get out that quickly. I'm just really happy. Like when I put the trade on, right? I want to get out now, right? I don't want to wait 2 days. I don't want to wait 3 days. I want to get out now. So I want to get out of the trade as soon as possible. And then I don't want to put the trade on until the next entry in the monthly cycle because I like being out of the market. I don't have any risk. I don't have any management overhead. But I'm trading for income, right? I'm strictly trading for income. So once I get my income for the month, I'm happy. I don't need any more income for the month. I've done it with very little risk. But I understand that a lot of people are trading this approach for more of a compounding or wealth building approach. So what I have had a lot of traders tell me is that they're using the weekly options. Like when I put this course together, the weekly options I think were available. I don't really remember. They weren't really on my radar, but I think they were always like 7 days out, right? But now if you look at the options chain for the RUT cash index, or any options, most index options out there, you'll see weekly options all over the place, right? So the requirement for our trade is that we use options that are about 30 days out, right? So it used to be that we'd pick the 30-day, and then there might be a weekly, but it would be just 7 days, right? So it wouldn't really work with our strategy. So now there's almost always a weekly option that's about 30 days out. So a lot of traders are telling me they're using the weekly options. So they get out of a trade and they look for the next weekly option that's 30 days out, and they put the trade right back on with the new expiration month. And the reports I'm getting is that the people are very successful doing that. Obviously, you end up having more management for yourself because you're basically always in the market. So if you're willing to do that, it's perfectly reasonable, right? Each of those trades probably have the same statistical expectation of profitability, right? There's nothing unique about each one. Shouldn't be that unique, right? It's like there's nothing statistically different about it. However, the way I see it is that there's a loss opportunity out there somewhere, right? There's a set of conditions where I'm going to take a loss, and so the more I'm in the market, the more likely it is that my trade's going to coincide with that loss opportunity, right? And so I kind of like, for my income trading, I do different stuff for wealth building, but for income trading, I like being out of the market if I can. Peter's asking, what's the difference between pivot points and smart levels? So pivot points are basically, they cover kind of a broad area. It depends on who you talk to, but basically pivot points come from a mathematical formula, right? They'll take high plus low plus close divided by 3, something like that, right? And they'll come up with a pivot point. And there was I think it was called ACD method a while back, where you'd look at the opening range, and then based on some formula from the opening range, you'd figure out pivot points for the day based on that opening range. That was really popular for a while. But at the end of the day, all those techniques are mathematical formulas, right? And there was a point at which just had a profound revelation that the market isn't mathematical. It isn't a mathematical problem. It's more of a organic entity. So smart levels in the auctions attempt to attack that, right? Excuse me. what we do with the auctions is they're much more organic. They're in tune with the market, what the market's actually doing. So if the market's making big moves, the auctions are going to be bigger, right? Our smart levels are going to be farther away. If the market's really sort of sedate, low implied volatility, the smart levels are going to be closer together. So we get this sort of organic connection with the auctions that are actually happening in the market. And I think that that's the big difference. It's not going to be based on some formula that works for a period of time and then stops working. It's something that's in tune with what the market's actually doing. So I think that's the big difference. Gary's asking, what's the difference between smart levels and market profile? So on my website, in the free video section, if you sign up for that, there's a couple of videos that go into a great detail about market profile and why I think it's broken. But it's based on auction market theory, the same as smart levels. It's just the technique they use to pull from auction theory, I think, is flawed and kind of ham-fisted. But if you really wanted to detail it out, you can watch those free videos on my website. But with smart levels, it's much simpler, right? We're just finding the auctions. So the technique I teach in the course is to find those auctions. We look at the chart after the market close every day, and we find those auctions. And the way I kind of, I really hate to call it a pattern that we're looking for, right? Because I traded patterns for a long time, and they never really work. So I'm very hesitant to call it a pattern that we're looking for. The other thing is, like with patterns, chart patterns, they happen very infrequently, right? And then you don't really know that you saw it until it's passed. You go back and look at it, it's easier to see. So patterns, I don't think, are a very good way to trade the markets. However, there's this phenomena that happens every day in the markets. There are some days where the market's just a straight line trend, right? And you won't see any sort of auctioning happening. But almost every day in the market, you'll see this auction happening in the chart pattern. And once you have an eye for it, once you start seeing it, you're going to be surprised that you never saw it before. And so it's different in that way. It's more organic. It's in tune with what that market's actually doing. But if you want to, you can watch those videos on my website. Mike's asking, is the 5% net after commissions? So let's break it down a little bit to kind of explain that. So in order to trade 1 unit of our strategy, you need $4,000. You need to set aside $4,000. You can trade as many units as you want, right? But each unit, you need to have $4,000 set aside for that. Now, we don't use up all the $4,000 in margin. There's usually a cash component that we use to make adjustments. And our profit target is 5%. So we base our target on what we set aside to do the trade. So we set aside $4,000. Our profit target is $200. So yes, we take into account our commissions when we're setting our profit target of $200. So we want to make $200 after commissions are paid, right? So hopefully that answers your question. Bob is asking, can you plot the smart levels in Thinkorswim or TradeStation? Okay, so all that's required to plot the smart levels is, let's say, a 1-minute chart. In the course, I kind of use the Renko chart a lot, but it's really not necessary. I think a lot of people get hung up on that. Let's say you're just looking at a 1-minute chart for the trading for a particular day. You're going to be able to see the auction on there. And then as long as your software allows you to put a horizontal line, you're good, right? You just want to put the horizontal line on there so you can see the top of the auction and a horizontal line at the bottom of the auction, and you're done. Okay? Sometimes there's 1 auction during a day. Sometimes there's 2. Sometimes there's even 3. So as long as you can put the lines on the chart, you're good. You don't need anything special tools or anything like that. Bob's asking, do the smart levels work on Forex? So it's interesting because I kind of originally thought that volume was a pretty important part for seeing the smart levels. But once you understand the pattern, you can take that to another market that doesn't necessarily have accurate volume. Forex, basically what happens is, like on the S&P 500, let's say E-mini futures contract, if there's like 5 contracts traded, you'll see that 5 contracts in the volume. Whereas Forex, the way I understand it, I've never really traded Forex much, but the way I understand it, the way the volume's reported is, like, say, if one guy does 5 unit trade and another guy does 10 units, they both come through as one trade. So the volume would be 2, right? 2 trades, but they were of different sizes. But I think what happens in Forex is there's just so many people trading one contract, then it kind of, the difference in sizes kind of gets muted out. And so there was a period of time, I had a trader I was working with. He wanted to know this exact question about the Forex, and so I basically traded it. I gave him the smart levels for 2 weeks straight on Forex, and they worked just about as well as any other market. So the short answer is yes. I think they work on Forex or any frequently traded market with good volume, good trading volume, right? Not necessarily reported volume. All right, Sam's asking, can you trade the strategy in an IRA? So yes, Sam, the short answer is yes. Basically, the only thing you can't do in an IRA is sell stock short or sell naked short calls. And we don't do either of those two things. It's always a fixed margin, fixed risk trade. So we don't have any naked risk. Gary's asking, are you stuck behind your computer all day? The short answer to that is that I may be stuck behind my computer all day, but it's not for this trade. So I live in California, so the market's open basically over my lunchtime, and so I'll often meet friends for lunch and things like that. And so what I'll do is I'll take my iPhone and I'll follow the market on my iPhone in real time, so I know where it's getting at. It's usually getting maybe it's getting close to one of my adjustment points, and so I can kind of follow on my iPhone where the market's at. Right, I'm not going to really worry about it too much till it starts getting close to one of my smart levels. And then throughout the day, even if I'm at home, I'm not really in front of the computer, I'll get alerts if certain price levels are hit. But when I'm out, I can follow along on my iPhone. Now, I don't trade on my iPhone. I think maybe I could, but I don't because it's just too small. So I carry around with like a notebook computer, and then I'll connect to the internet through my iPhone, through the personal hotspot if I need to actually make a trade. Now, it used to be I was trading this at a time, and I think it was 2005. I basically had a flip phone. I didn't have a smartphone, but I would get text messages. And what you could do is in the Thinkorswim software, you could have the alert sent to an email address, and the text messaging on my flip phone had an email address. So that's what I used, and so I would get alerts when certain price levels are hit on my my flip phone. And then what I would do is I'd call the Thinkorswim trade desk, and maybe I'd ask them a few questions. I usually carried around with like a piece of paper with my details about my trade on it. So I'd ask them a few questions about where things were, and sometimes I'd place a trade through them. So even if you don't want to carry around like a notebook computer, you could call in your trades after you get alerts on your phone, and just about any phone can get alerts. So hopefully that explains it. This is a fairly low overhead trade, and the other thing is that even though we're making adjustments during the day, a lot of people think, oh, well, that'll be day trading, right? Well, I think it's very different from day trading. I've done day trading, and day trading takes a lot of concentration and commitment. for this trade, we adjust during the day, but we already know what we're going to do, right? We're just executing. You know, we get an alert. And in the Thinkorswim software, you can have your orders staged ahead of time. You can have saved orders. So basically, you already know exactly what order you submit. You just wait till the timing mechanism, which is the alert on the hitting a certain level, and then all you got to do is pull up that saved order, shave the limit price, maybe submit it, maybe cancel, replace it once, and you're done. So there's very little overhead actually for this trading approach. Okay, Rajesh is asking, do you need to get option view? The short answer to that is no. I don't even have option view anymore. The main reason I had option view at one time, and it's in a lot of the videos, is because it's a really good. It was basically the only tool at the time for back testing options data. So unless you want to do your own back testing, I don't think you need option view. Rajesh is asking, so what tools are needed? So basically, your broker software is probably sufficient for in 90% of the situations, right? Your broker software, as long as it has a good option chain, it's a reasonable method, easy to use for submitting, canceling, replacing orders, that sort of thing, you're probably good. Now, one of the things that I think a lot of people would like to have is a risk graph, because our trade gets, a little complicated. Sometimes it's hard to visualize. So if you can have software like the Thinkorswim software that allows you to do a risk graph, that's great. I actually have a video in the course on how to use the Thinkorswim risk graph properly. I had basically some feedback from people asking questions, and they were getting the wrong information from the risk graph. There's only about 5 things you need to know to make sure you don't screw it up, and so I just create a video to go over that. But it's a nice tool to have, but certainly you don't need it to trade the strategy. The other tool that you want, if you're using the smart levels, is you need a charting package where you can see like 1-minute data. It can be even delayed, right? Because we don't do our analysis for smart levels till after the market's closed. So 1-minute data delayed, and as long as you can put horizontal lines on the chart that you're trading on, you should be good. All right, Sam's asking, what is the maximum size you can trade? Okay, that's a really good question. When I first started trading this and was being successful at it, I seriously looked at doing like a hedge fund or something like that. And I quickly realized that the volume that you need to trade wouldn't be supported by the RET options, or for that matter, any other market. So I kind of gave up on that idea. But my best guess at the time when I was doing that research was that you could trade about 1,000 contracts on the RET cash options index, RET index cash options. So 1,000 units is quite a bit, right, for individual traders, but not so much for managed accounts or hedge fund. So for individual traders, I think this strategy works great. If you're thinking about trading that large, I trade maybe 50 units. I had one gentleman told me he was trading 125 units, which is about $500,000. And the first thing I asked him, obviously, was like, well, how's your execution, right? Because that's where it's going to show up. If you're used to trading small, you're going to know what normal execution is. And then as you ratchet up your size, at some point, right, the guy on the other side of the trade is going to go, oh, this is too big, what's going on? And they're going to be worried they can't hedge the other side of the trade. And so that's where that's where it's going to show up, is in your execution. So I would say that there is a limit out there somewhere. I don't know where the limit is, so I can't really answer your question because I just don't trade that large. But certainly for the individual trader that's trading less than 1,000 units, I don't think you're going to run into any problems. Okay, that looks like it's the end of questions. Thank you everybody for calling, and feel free to contact me if you think of any questions later. I know it's hard to think of all your questions at once. And thank you for coming today, and good luck in your trading. Take care.